Snowflake had $1 billion quarter, growing 26%. Databricks just said they're crossing 4 billion, growing 50. It actually makes Databricks sound undervalued.
Now, this episode is a cracker. We discuss CoreWeave, Nubank, Databricks hitting $100 billion, and much more.
One thing I've learned about large amounts of money, what people say they'll do is meaningless. When you get the $10 million or $100 million offer from Meta, it rocks you back. And that's real competition. And at some point, you got to match the dollars.
I think we're all going to live in AI 24/7, and we're all going to use 10 times the tokens and 10 times the compute we are now in 24 months. Like, help me do the math. How much more do we need to spend on infrastructure?
One of the things I'm learning, especially on this podcast, is to not to try and feel the need to have an opinion just to fill the space.
That's why we have Jason.
Ready to go?
Guys, it's the holiday edition. I am dialing in from Greece. You guys are dialing in from the office, but we still get to do this. My mother is sitting outside and she's like, "Are you recording the Rory and Jason show?" I'm like, "This is the one show of mine you listen to these days." She's like, "It's my favorite." So
that's because we're mean to you, Harry. And, you know.
I think she actually likes you. She says that you bring me down a peg or two, Rory.
It needs doing, Harry. It needs doing.
Listen, I want to start with Databricks. Now at $100 billion, worth more than Snowflake, I wanted to start with how we thought about news of it hitting $100 billion. And we can touch on that first before we move on to what it means in terms of founder-led companies and them inherently being better or more valuable.
Well, I'll tell you, it's funny. When I saw it in the journal, it shows the times we live in. It seems small. I mean, Snowflake's worth 60-something billion. So the private worlds and the public worlds are like two different worlds. But this is if I'd seen this a year ago, I would have fallen out of my chair. This is just for fun. Then we could talk about its relative, whether it's a good, Rory will help us figure out if it's actually a bargain. But it's funny how I don't blink an eye for 100 billion in the age of AI. I just didn't even blink an eye.
Yes, that is the meta comment. You're exactly right. It's like, oh yeah, Databricks is if you'd said 5 years ago it's going to be $100 billion market cap private company, you'd be like, no way. And you got Anthropic at 170, you got SpaceX at 360, you've got OpenAI at 500. You're like, the correct response is yeah, like whatever. Exactly. So another $100 billion outcome. It's awesome. So yeah, you're exactly right. That is the first comment. And then, the second thing, to Jason's point again, is you just have to size it on the comp. And, I will admit, I saw the announcement and I didn't have time to dive in and read the numbers. So I haven't had the most recent update, but
they said they'll hit 3.7 billion ARR. They've crossed almost 4 billion. They've crossed almost 4 billion.
And what that means is versus Snowflake, the growth rate is higher. I'm doing this on the way. So you have that perfectly positioned infrastructure provider to everyone who's messing around in AI. You have the growth. It's a healthy multiple, to say the least. But provided the growth's there, on a comps basis, it's not entirely crazy. Going back to my, what value do you get in the public market versus private markets? I've always said if one gets out of whack with the other, things go the other way. People gravitate to where the cheapest capital is. This feels roughly right. In other words, this feels like roughly where it would price in the public markets in a world where Snowflake's market cap is 50 or 60. If this is bigger, growing faster, okay. It was like, yeah, that's probably what it's worth. Obviously.
Yeah, they've argued actually looking at it. I think they've crossed over. Snowflake had $1 billion quarter, so that's 4 billion, growing 26%. Databricks just said they're crossing 4 billion, growing 50.
Yeah.
50 and 26 are they're pretty different. It actually makes Databricks sound undervalued if you think about it.
This is what I was just going to go and say, which is like, it actually feels undervalued at 25x revenue, given the growth rate, given the fact it's founder-led, given the macro trend where it sits. It really feels like actually very reasonably priced.
I just love it. Just another cheap stock at 25x run rate. Again, it's all about growth persistence. Because, in one sense, the interesting thing is every one of these bets is some version of, if you're paying 25x run rate for anything, what you're really saying is, the only thing for sure is that when things level out in growth rate, they get valued like normal companies. So implicit in that is some statement about how long this company can continue to grow at that kind of rate. So if 2 more years at 50, 60%, you're golden. You've earned your way into the company, into the valuation. If that growth ever kind of plummets down, then you're high and dry like many of the 21 deals. So the valuation totally makes sense, provided that growth rate goes 50, 40, 35, 20, not some precipitous growth rate decline. That's the bet. So it resolves itself again to if the AI boom continues for 2 or 3 more years, all this it will be trading at that point 8 or 9 times run rate, and all will be fine. That's the bet in a sentence.
I actually interviewed Rory O'Driscoll, their CRO. Astonishing guy, by the way.
He was there from almost the beginning, right? Almost the beginning.
0 to 4 billion in revenue as head of sales and CRO. He said they were 5 years ahead of Snowflake in the show. I thought it was just I said, like, technologically, how far ahead are you? He said 5 years. I thought it was interesting of him to state.
Yeah, I'll tell you a couple things. The one thing I thought is cheap. The other thing I was thinking is, Sam Altman said this week that one, they're going to spend trillions on infrastructure, but also that a lot of folks are going to lose a lot of money in AI, that there is a bubble. He said two things that aren't completely incongruous. But the other thing I thought when I looked at Databricks is, like, obviously it feels very bubbly right now, right? It feels like the best of times, but it might get better. And not just because OpenAI is going to continue to grow, but because let's look at comps. Okay. Databricks hasn't IPO'd yet, right? Databricks compared to Snowflake growing twice as fast at 4 billion. Figma and crazy IPO we just had, right? One of the reasons Harry's in Greece, but Canva might be even better. And maybe Stripe is accelerated. I don't know if Stripe's going to be better than Adyen, but let's imagine it's accelerating because of crypto and AI and mobile. We might get the next wave of IPOs that are even better very quickly. And the amount of froth that could create in the ecosystem, the amount of returns to LPs could create a bubble on top of a bubble, because times might just get much better in the next 12 months.
There's an interesting question to be had here, which is, given what we've seen with Figma, CoreWeave, and Circle, if you had the likes of Canva and Databricks go out,
they're better.
The public reception would be even more inflated.
Maybe. You could also argue that, just to make the counter argument, you could argue that a little bit of what's happening now is scarcity value. There's very few high growth companies in the public markets because all that growth has been annexed by the private markets as a bizarre outcome of, ill-informed regulation. So all the wealth creation is taking place in the private and the private side. If all those companies were to go public, as you say, if the Canvas of this world, if the Databricks were to go out, it's not clear to me that they'd get that 3x pop. Instead, what have is, okay, they'd probably trade at their very high, quite deserved values, but I think the scarcity premium would go out of it, right? For example, I can't remember, it's been 2 weeks now, like, Figma at a Canva equivalent where Figma priced at 15x forward. Yeah, sure. A Canva equivalent and a Databricks equivalent then popping 3x, probably not. Because at some point, they would all be just wonderful public companies trading at appropriate growth adjusted multiples. But what it really would be is taking $1 trillion off the private balance sheet and putting $1 trillion onto the public balance sheet, where it could easily digest it. Because, U.S. stock markets are, 40, 50 billion. So another trillion, 50 trillion, it can digest another trillion. So you could shove off onto the public markets an amount of equity that at appropriate multiples would, as you say, Jason, lead to a huge amount of LP capital return and be totally digestible by the public markets, probably without the 40 super premiums. Just, it would be the return of high growth companies in the public markets.
Let's look at, so Snowflake, Databricks growing twice as fast as Snowflake at the same AR, which is stunning. Figma growing 48% at $1 billion.
Yeah.
Pretty crazy. Yeah. Worth 40x ARR today. It could change. I mean, it's frothy, right? But if Canva IPOs next year at 4 billion instead of $1 billion, growing 40%, and Figma's at 48%, I mean, that's a much better. Figma's one for the ages, but that's an even better company, isn't it, Rory? If it's growing 40% at 4 billion, I mean, it could be a jaw dropper if multiples and market dynamics are consistent with today.
Yes, again, as I say, and it would trade like a wonderful 40% growth. Look, the absolute number would be bigger. The multiple would be growth adjusted. As I say, my comment is merely the speculative. I mean, yeah, the speculative side of it that took it, from the IPO valuation, probably would not be there as more stocks come out. But it's still, look, it would be the aha here at the high end of the private market. There's a significant absolute sum locked up in private markets that at some point is going to seek a public market where a number of them will be worth 50 billion, which is unprecedented. A few will be worth 100 billion. And maybe one will be worth $1 trillion in the private markets. And your little head would hurt. Because I remember, it's only 2018 that Apple, if you think about it, this is a weird comment. It was only 2018 or 19 that Apple touched $1 trillion in the public markets. And 7 years later, there arguably, I'm not sure I buy it, it might be one or two private companies that touch $1 trillion in the private markets. That's just bizarre.
I go back to this, and I've said it so many times, and I've said it in this show so many times, but David from VenCap, who said that the biggest mistake we make is that we look at today's fund sizes and today's outcome sizes and think that is what it will be in 10 years' time. We should be looking at the outcome sizes of 10 years' time and thinking of these fund sizes rightly correlated for those. I always think back to that, because if you were to do that, you might actually have a more reasonable and nuanced mindset towards the fund sizes we're seeing today.
Yes, you do make that point very consistently. And at some point, and again, I think it's true, but you're probably also guilty of over extrapolation, but that's okay.
I mean, listen, the IPO floodgates are open, right? Even a couple months ago, we could have debated it. But if you think about it for a minute, the IPOs we've had this year, they're just, they're not the epic ones, are they? They're not the epic. The epic ones are still to come. Like we have, what is the big epic? I mean, we've had a few fits. We've had the Rubrics and the Klaviyo's and Figmas, but the mega ones, I think it could just be a force of nature coming. These are small. The CoreWeave has a huge market cap, but CoreWeave, Circle, Hinge Health, these are still niche plays, aren't they?
Tranmere Rovers. Yeah. Yeah,
I got it. A reference that's wasted on your audience, but yes, I just wanted, but I do want to. Yeah, I don't think they're just niche play. I think they're the bread. Look, the truth is, both sides. They're the bread and butter of what will make most venture firms money. So I'm not going to denigrate them with niche or Tranmere Rovers appellations. But you are right, Jason. In a power law world, look, it's nothing more than saying in a power law world, the longer you let things cook in the private markets, the bigger one or two of the outcomes will be. And things have been cooking in the private market for, I think SpaceX is almost 20 years old. They've been cooking a long time. So it totally makes sense that there's going to be 5, 7, north of $100 billion outcomes. It's just the math. I'm super happy with DOCU as a company in our portfolio. Fraud detection, growing at scale, many hundreds of millions of dollars, profitable, accelerating growth rate. We're in on a wonderful basis. He said, smiling happily, about 120 pre. So feeling very good there. That's, and to the point, and I want to go back to it. In the context of what Jason says, it's a niche play. It's not doing $4 billion. In the context of a mid-sized fund with a good ownership position, a company like that, with a trajectory like that, I feel great. Right. And, there's going to be 10 or 15 companies that, are that 10 billion plus, 50 billion plus outcomes. But the real point, the venture business will only work for a few funds if they're the only outcomes. For the venture business to work for us all, you're going to have to see more of these $5 billion market cap outcomes. Yeah, as you say, the Hinge Health, the honors of this world start to take place. And I think it will.
If Databricks IPOs next year at 200 billion, which makes sense because that's the implicit goal of this valuation, Andreessen led the seed A, how much do they make in what fund, and how does that change how we think about fund dynamics? Could they own 15% of Databricks? It's possible, right? It's hard these days, but it's possible. So if they make 30 billion on the Databricks IPO, how big was that fund size, and how much does that further reinforce the cycle we're in? It seems like a lot, 30 billion.
30 billion is a lot. That's very clear. No, look, again. And if the growth slows and it grows and it has to go public at 80 billion, which would be a heroic win in any man's terms, it'll feel like a real Debbie Downer from where we are now. You're exactly right, Jason.
I'm just thinking through I'm trying to figure out what fund size that would be in, just going to Harry's point of the mega rounds and things that make sense today. Because we're going back in time, because the beauty of these types of investments like Andreessen leading Databricks in 2017 is you get the benefit of of the VC economics of its day. They probably overpaid in 2017, right, as an inception investment, and it would probably be seen laughable today by the same
I think
token,
it was even
right?
earlier than 2017 because I remember.
Oh, you're right. I got it wrong.
Yeah, you did, because I remember we were trying to talk to, we were in a conflicting investment. But
that was the D in 2017, a decade ago. They let it a decade ago, better part of a decade
more
ago,
than
right?
I want to say 2013, 2014. I could be wrong because Snowflake had just started out. But yeah, I mean, look, what it says is shock horror. If you do the best infrastructure deal of your generation, and you hold it for a decade and a half and it compounds, it turns out you make a lot of money.
I go back to a statement that you say, which I love, Rory, which is like, Josh Kushner, phenomenal investor, goes to the best block or the best house on every block,
Yeah.
AI, OpenAI, Databricks, Stripe, FinTech, and buys the best asset.
Yeah. Buy the quality asset, hold it. I mean, look, the only risk is, I mean, all these, and I'm not saying this to be a Debbie Downer, but just to point it out. The interesting comment is, in the public markets, when things start going south, because there's liquidity, everybody can have a stop loss of 10% and get out, and then someone else can come in, think it's going to turn, and you can hold it all the way down, but you can also get out along the way. What's interesting in the private markets, you don't have that option, right? If you're wrong at 100 billion, you'll own the thing, and obviously it won't go to, it'll be, if you're wrong on price by 50, 60%, you'll own it the whole way down. So the only risk you're running is a one big, large ass pricing risk, right? And I don't think you'll have preference to save you, but so far that risk has worked. And it gets back to my comment on growth persistence. If they continue to grow for 2 or 3 more years and you have a run rate business at say 10, 12 billion in, ARR or GAAP revenue, then you're kind of money good on normalized multiples, which is how I think about it. Can you get from where you are, which is crazy multiple, in 3 or 4 years to being money good on normal multiples for normal growth rates? And provided you can visibly see that growth rate, you're good. And if you're doing 4 and you're 40% growth, what you're basically saying is this infrastructure investment in AI keeps going for 2 or 3 more years. And then I have 10 billion of locked in contracts with JP Morgan, B of A, OpenAI, everyone. And even if the world, slows down from there, I'm good. That's the bet.
Harry, not to do too much time on this, but just thinking through it for a minute. If Andreessen did the seed/A in 2013 out of a $650 million fund at the time, trying to line this up through AI. It's probably not perfect, right? But if they did it out of a $60 million, obviously they probably invested in multiple funds, cross funds, right? But boy, they've got some good funds.
Absolutely. Yes, again. And I think, I think you're probably, because, and this is David's point, for Venka, I'm willing to bet they have the guts of $1 billion in that deal. Could be wrong,
yeah,
but $500 million at least. Because when you have something like that, you follow it the whole way up and you put a lot in. And, the interesting thing is you probably have a couple of 100x multiple on your first investment. You'll have some 20x multiple. You might have some late stage 3x multiple. But if you've turned $1 billion into $30 billion, you're going to feel good in the morning.
The one thing I also think we don't take enough into account is just how many people make money when these go out. And what I mean by that is there are so many LPs who are in SPVs, SPVs on SPVs. There are dentists who are going to make 5x. And I'm saying that positively, and we always pick on the dentist, which is unfair of us. But the multitude of winners when the SPVs are as sprayed as they are in these mega companies will make a lot of people a lot of money in a great way.
Yes.
Yeah, buy a house now in the Bay Area. That's my main recommendation. Buy a house now. They're all going up. They're all going up.
We can real estate with Jason Lemkin.
That's all I know over these cycles is you buy a house before the next massive IPO wave. Why is everyone paying cash?
Speaking of which, guys, I want to usher this along. And Rory, you're going to freaking kill me because it's a bit of a late edition. But it's like peak bubble time, some might suggest, when you see the return of the SPAC. And Chamath announced his new SPAC today. And in the prospectus, it says if they do lose their entire capital, they will embody the adage from President Trump that there can be no crying in the casino. I respectfully thought this was peak bubble. I would love to hear your thoughts on, is it peak bubble and am I being too moralistic?
You won't know it's peaked till it goes down the other side. So you're not going to, because it's interesting you say that. And as yet, I'm listening to the two of you and your euphoria 5 minutes ago saying, oh my God, this is just the hors d'oeuvres and the entree is coming later in terms of the public markets. If that's the case, then it's not peak bubble. He'll be selling into strength like he did in 2021. All right. So that's the first comment. So I don't know if it's peak bubble or not. If I did, I wouldn't be wasting my time talking to you. I'd be trading the QQQ and making money, right? It does definitely. I mean, what can you say? You can say a couple of things. One, it does seem to remarkably correlate. The return of Chamath to the SPAC market does appear to correlate with the most recent bubble in 2021, where it worked in the bubble and didn't work after. So there's definitely correlation there. I'm loath to impute causation, right? And, the serious comment is, because, way more serious people, I remember Bill Gurley talking a little bit about SPACs. It's not a crazy alternative to, on its face, to the problems around IPO and mispricing. But I believe when you parse through it, it's a bad structure. And I think it's been validated to be a bad structure in 2021. Relatively few of them worked. Though, to give credit, I think SoFi did work. I think it priced at 10, it's now $23. Most did not, because you have all sorts of weird adverse selection, right? So especially in bubble times, it's a pretty iniquitous and expensive vehicle to raise capital in the public market. So I'm just not a wild fan of SPACs. I think you get adverse selection in terms of who decides to do the deal. And the other thing is the incentives aren't aligned, because the person doing the SPAC effectively crystallizes their entire gain once the deal gets consummated. And, obviously, if the outcome is great, that's wonderful. They make even more money, but provided they have an outcome, they make some money. So the structure is all wrong. You effectively get paid as the promoter the day you get a deal done. And, one thing you learn in any investment management business is if you pay people to do deals, deals get done regardless of the quality. So I just think it's an imperfect vehicle for fundraising. And therefore, rather than personalizing it on one person, be he ever so great or not, I just think it's a bad structure, and the fact that it's back is indicative. The fact that the structure is back is indicative of a bubbly time. That was me being nice.
Jason, is it below your line?
I only know Chamath from a distance, back as a founder, watching him back in the day, and then as an initial VC investor at Social Capital. I do have a ton of respect for all of them, but I've honestly never listened to it. But I know David and Jason a little bit. I don't get why he cares. This seems like a lot of energy for someone reasonably rich to be, going to Rory's point, to be doing weird shit like SPACs. It's not a criticism. It seems, maybe he'll make $50 million off this. Help me do the math, right? As the sponsor in this, but why? Why not do something more meaningful with the world rather than do something like a SPAC, which is at the edge of grift? Like, no crying in the casino. I appreciate the disclosure, but this seems to me something better for someone on the way up, like for trying to get their first 100 million. This might seem like a good strategy, but I don't get why the billionaires are maybe approaching. I don't know. It's none of my business how rich he is. The juice doesn't seem worth the squeeze here. The drama, it doesn't seem worth it.
I agree. Because I think you're right, by the way. My mental model is the amount you raise, 20% of that. So you get 50, but you have to gamble 5 up front on fees. So that's it. It's a 10x. The day you get a deal done, it's $50 million. And then you hope to hell it goes up, not down. You probably get out. If it goes down, you probably get 25, but that's it. You're right. It seems like a lot of pain and drama. And also, on the disclosure, I'm going to get moralistic, is that I think at first level it's cute, because I do like the fact that there's humanity creeping into these disclosures versus, I remember back when there was no founder letter and there was nothing except bland legal speak. So I love the comment on crying in the casino, but it's not a casino. The point of it may feel like a casino to some of the marginal players, but the point of Wall Street is to funnel, and even these IPOs, is to funnel money from the savers of ordinary people, managed by people like Fidelity, into profitable long-term investments. That's why we have the whole damn thing. Wall Street, all of us getting highly paid to allocate capital. It's not a freaking casino, which is a zero-sum game where only the house wins. It's about allocating, about $2 trillion worth of savings every year into great new investments in companies like Figma. It's not a casino. So it's a cute statement, but I personally would never let anyone manage my money who thought it was a fucking casino. Excuse my language. Who thought it was a casino. It's not a casino.
Is stuffing retail investors' 401ks with PE a casino issue? With PE investments they don't even understand, they have no financials for, don't know what the markups are. Is that at the edge of a casino, crying in a casino?
I understand what you're saying, which is that it's the more unsophisticated the investor and the more complex the instrument, the more likely it is that the investor will lose and the promoter will win. It's one of those life rules. It's why even in IPOs, there's complex things and you kind of go, whenever it's complex, your rule of thumb should be whenever a banker is explaining something complex, you're losing money, right? So I don't think it's as bad as, quote, the casino, because I think on aggregate, because stepping back, the casino comment is this. In the casino, the median expected return is negative because the house takes a take and, the median is a loss. Even PE, look, the long-term returns in PE are good. The long-term returns in venture are good. So in theory, allowing individual investors to access those returns might have meant some individual investors would have got the Databricks exposure that Andreessen got. So it's not a bad idea. But to your point, Jason, the problem is often the more complex the instruments are, the more likely it is to go wrong, the more likely it is to be adverse selection, the more likely it is that, the good parts of the PE and venture value chain don't get allocated to the retail investor. So I don't think it's casino level. I do think it requires a fair amount of disclosure and monitoring.
There was an example on X Twitter. I wish I'd saved it. I think I saved it. I'll look. But it was a PE firm that had to do public disclosure about a secondary position it bought. So it had bought another position with 50 investments in it and disclosed it and got it at a 20% secondary discount and the next day marked it up.
Yep.
Right. And the disclosures were in like 3-point font and asterisks and daggers at the end of the disclosure. And the point was a retail investor would think there was, the IR would be insane for the next week, but a retail investor would think they had a 20% gain this year. They bought Scale 7 or SaaSter 1 at a 20% discount, immediately marked it up because to mark to market, and the fund's up 20%. How would a retail investor even understand what the hell was going on there, or if that's even legitimate?
I think the interesting, and again, Harry, you're right, I am annoyed at you because I haven't thought about this at all, so I'm working on the fly here. But I think it gets to an interesting philosophical question. There's two approaches. There's if I disclose everything, it's buyer beware, right? Which in this case, and this is an example of that, and SPAC's an example of that. Because it is true to say, every single thing you needed to know to stop yourself getting screwed over was available in the prospectus. And so there's one school of thought that says, on your head be it, you made your own decisions. And there's another school of thought that's a little more nanny protective and says it's just not realistic for individuals to all do that level of analysis on something, managing their money, where they spend, 3-5% of their time. And therefore individuals, quote, need to be protected or regulated. And I think, what we're seeing right now is probably by virtue of the overregulation, I think, no one could get, there's a feeling now that we're going to wrench the needle back the other way to perhaps a lot less protections. I think it's a happy medium. It's a hard thing to decide because, in protecting those individual investors from the grift, as you put it, Jason, of a fund that has an arbitrary markup that's not there, you also, quote, protected them from being able to invest in that Databricks round at, 500 pre that's now 100x. And getting that, rather than doing what I think we do a lot of, which is this, black or white thing, it's pretty tricky. It's a tricky regulatory balance to say, how do you allow people a fair amount of freedom to pursue what they want to do, treat them like adults, assume the disclosure is there, while at the same time avoiding those horrible stories of, little old granny gave her money to XYZ Wireco and they just lost all her savings and now she's penury on the street. So it's tricky.
I am going to take it back to regular programming, Rory, because I don't want to piss you off too much. My mother can't be too thrilled to see me getting a beating. I want to go, actually, we said there kind of about the extended period of privatization for companies, SPACs being a different mechanism of getting liquidity. There's a $6 billion secondary for staff at OpenAI, and a lot of them are going to make great money. at scale. What do we think of staff secondaries at this level of scale, which is in the multiple hundreds, if not low thousands now, or low thousand, getting this level of secondary? First start there.
Good for them. And it's, and it probably speaks, look, again, it speaks to willing buyer, willing seller, a couple of things, and informed buyer. And it also speaks to, look, we've talked about this, given the competitive pressure that Meta has exerted on AI salaries by being willing to offer people cash positions, allegedly, and I haven't, $10 to $100 million. If you're sitting there in OpenAI, yeah, you can talk about the mission till you're blue in the face, but it's going to help a lot if you can also take off $10 million. So you're going home. Because it's all very, one thing I've learned about large amounts of money, as I see this in acquisitions, is one of my rules is this: what people say they'll do when faced with a large amount of money is meaningless and bears no relevance either way to what they'll actually do. Predicting who wants to sell their company based on what they say in the abstract is a waste of time. Taking these offers, when you get the $10 million or $100 million offer from Meta, it rocks you back, I'd say. And, you go home, you talk to your spouse, do we want to do this? This changes the rest of our life. And that's real competition. So if you're OpenAI, you can preach the mission, but at some point you got to match the dollars. And that's, if you think about it, $6 billion, it's only $100 million engineers. It's only $10 million engineers. Stunningly, to Zuckerberg's comment, it ain't that much, which is hilarious, but wow.
Jason, he's turning into you. This is the full-scale transformation of Rory.
Well, you know what? There's the competition issue, which is critical. Rory's. I just think, stepping back for a minute, it is nice that as companies get bigger, stay public private a little longer, if literally this is institutionalized. We talked about tender offers and all that. I think more if they actually act more like the public markets, where every month you vest, right, and you got to stay to your cliff, and all that stuff works, but. If it's pseudo public, right? And so you make it 13 months, you sell a 48th of your stock or a 60th or whatever it is. That is, it sounds audacious, but if you step back for a minute, that would be a nice outcome, right? Where it just works that way as a late stage company. Forget about tender offers. It was just almost automatic. Every month you could sell your vested shares.
Agreed. To use a silly example, but we just started on it. In 2000, as I say, Apple was 800 billion market cap going into 18. So let's go back to about 2014. It had a $500 billion market cap. You didn't have an objection to those people selling in the public markets. The only difference between this $500 billion market cap and that $500 billion market cap is, for stupid, absurd reasons, it's still private. So I'm totally with Jason. If we collectively want to recreate the entire mechanism of the public market at massively more expense, massively more transactional cost, then more power to us. And part of that is being able to sell.
When suddenly a large portion of your employees are multi-millionaires, does that impact the cadence of their work?
I think money brings out what people really are, because it stops you having to do things you don't want to do. So the people who love their work are going to work just as hard or harder, because they'll be able to throw money at all the other little problems that take up your daily time, right? And there'll be people, and then other people who have other dreams in their life will go do other things. That's what always happens. And if you look, and because it's not a binary thing. People ask this question. We see founders get rich and then just keep on trucking, not sell a single share, and just compete aggressively the whole way through. And then you see other people go, I never thought I'd have 20 million. I have 20 million. I want to go teach high school. And that's just the way it's going to be.
I do think what we're seeing, to Harry's point, and I don't know saying this is bad. It is a cultural change or tech change. I do think essentially the handcuffs of staying at a startup for a while, so that you could see it through a liquidity event, and you would stay longer. If you left, you might not have the money to exercise. If you left, other things might happen. I think at the margin, those things are all weakening, as are implicit tenures for employees. It's all changing, right? But as VCs, historically, we've used the pool as kind of a retention weapon. Guys, if you stay, you'll make a lot of money. If you leave, and you can't afford your exercise price, well, great. I get half of it back. I get all of it back for my pool to give to the folks that stay, right? And some PE firms are extreme there. Like they have a lot of leaver clauses. You leave, you get nothing. And this is kind of the opposite, right? And I don't know if it's bad, but it is different as a way to lock employees down with illiquid equity.
I totally agree, Jason. It is. I love that. It is different. I love it. And you're right. And I think the kind of, we're all locked in this, and if you leave again, it made sense where it was a 4 or 5 year sprint in the mid 90s and you would go public at 50 million in revenue. I don't think it's realistic to have that attitude in a world where you can be 12, 15 years. So I think this evolution, to allow people to access their capital is just a more realistic, and other things like refresh grants get into the same thing. It's not just a 4 year sprint anymore. It's a 15-year marathon, and you can't expect people to put 15 years of their life on hold. And you have to allow, and not be able to do the things you want to do in life. And so you have to have these kind of events. I totally agree with you.
Is it a 15-year marathon when Story founder raises 130 million and walks away?
Well, it's only a marathon if you finish the marathon, Harry. It turns out if you punch out after the first mile, and it's not a marathon anymore. Yeah, it's a failed marathon.
How did we think about that? It was a big announcement, $130 million raised. And he leaves pretty abruptly.
Well, look, it makes sense in this era. We should see 10 or 15 Hoppins, not just one, Harry. It just makes sense. We should see it. If Hoppin was there's other Hoppins. We can talk about some other ones. That one's just a prominent one. We can think of several folks in the SaaS boom of 2020, 21 that walked away with too much money, right? But it makes sense. There should be double digits in this era, right? There should be 10, 20 founders who walk away with 9 figures. Whether they're WeWorks or Hoppins, there's got to be 20 or more of them, and it's a cost of doing deals over the. I find all hot deals now are done on Saturdays. This is the new founder vibe. You get an email, even if I know them. What's going on? Well, we're taking meetings on Saturday, and I'm like, can we? I work hard. We all 3 of you do, but like this Saturday I can't do. I'm like, well, if you're going to close every deal on a Saturday, we're going to lose a few $100 million here or there.
I find that hilarious. I'm with you on the Saturday deals.
There's got to be 10 Hoppins, doesn't there? Just mathematically, there has to be.
And maybe just stepping back to you should explain because most people might be like me, where like I haven't spent a second thinking about Story, right? So implicit in that is it's a company that raised 135 million. Sounds like the founder took off significant money, and lo and behold, as of today, he's not at the company anymore. Is that the summary?
Well, he has a new passion. He wants to start something different, Rory, all over again. And he might sell the rest to Windsurf or somebody, but he's moving on to his passion project.
Yeah, and now you're being a snark. I actually thought your first response...
Sort of.
No, but I thought genuine comment. I thought your first response was the correct one, which is, I didn't even know about this. There's going to be tons of these. I didn't even break sweat thinking about it, Harry, right? It's like, I'm shocked to discover that some deals don't work. Some founders end up either leaving or getting transitioned out, and some money gets lost. To me, it didn't even rise to the level of a Story. I mean, it's fun to snark, but like literally, it's like, Jason's right. Your typical venture loss rate, you 30% of your deals don't work out on, and that's on the kind of where we play A's and B's. It's probably 50% plus in seed. So, and I remember in 2001 and 2, the loss rate spiked to 60. So the fact that loads of companies that have raised $100 million go bust and, in tawdry circumstances, yeah, whatever. Didn't even rise to the level of interesting.
Okay, speaking of rising to the level of interesting then, one for me that really did, which I love, is Nubank. Reported earnings on Thursday, blowout quarter, net income reached $2.5 billion, up 42% year on year, 123 million customers. It's incredible. I'd love to hear your thoughts on this blowout quarter for Nubank and how you feel.
Sure. And I'm not going to do so much the quarter as just stepping back and talking about these fintechs. And maybe, it's interesting. And obviously, as people I'm sure know, Nubank is a dominant fintech, which is a next generation bank in Brazil, Colombia, and Mexico. And it's just interesting to kind of sweep up with Revolut, a dominant, fintech bank, a next generation bank in Europe, and maybe even Chime in the US, right? And I was kind of, you pinged me on this and it got me thinking, what do all these have in common? What do all these have different, right? I think what they all have in common is in the last decade, they found the weak, soggy, badly run and profitable parts of the existing banking infrastructure and attacked them voraciously, right? And if you look at the three companies and the outcomes, Nubank is public and worth 60 billion, Revolut private, maybe worth the same, and Chime, in the public in the US worth 10. The interesting thing is they're all different. They all found a different weak spot. And because in each of the three continents, it's a different dynamic. And in my view, it's no surprise that Nubank is the most profitable, and perhaps we can talk about Revolut in a second, the most stable, because frankly, the incumbent banks were weakest in LATAM. They were old, they were stodgy, they weren't serving their consumers, and these guys came in over the top. And they didn't just build a deposit base like Chime did. They've done the full Monty. They do deposits, they do lending. They've basically built a next generation bank. They've cleaned the clock on the average middle class consumer in Brazil versus the old guys. And as a result of that, they are now, depending on the day, the largest or second largest market cap bank in LATAM. Right. So I think what I like about Nubank in the context of the other two is that's what winning looks like, because banking is inherently geographical. So what you can now say truthfully is a fully developed bank that doesn't just do deposits, but does the full, gamut of financial services can end up with a market cap equivalent to the largest bank on the continent, right? Although it's probably still 5x smaller in terms of assets. That's winning, right? And if you contrast that, and as if you take Chime now, the other extreme, right? $11 billion public outcome, great company. But the US banks are pretty well run, right? Their niche, there wasn't as big a niche there, right? So where were they able to thrive? Two things. One is with the Durbin Amendment, they had this arbitrage on deposits, and they were able to, make money on debit cards and therefore without ever doing lending. The interesting thing is, unlike Nubank, they've built a profitable business without ever doing lending, which is the bread and butter of most banks. They've built a perfectly good business on deposit accounts and debit cards, living off the interchange. Now, it's an $11 billion, despite the US being, on the day, 10x larger GDP country. Chime is only an $11 billion market cap company, and I think that speaks to they were playing in a less profit-rich environment. There just wasn't as much money. JP Morgan might have seeded some of their, mid-tier customers, but these guys didn't roll over everybody because the banks here just weren't as inefficient as in LATAM. And then Revolut, obviously their edge very much in Europe was trans-country, moving money between different countries initially. And now, obviously, I understand, I've seen the numbers, Harry, don't worry, they're roughly similar size to Nubank, less lending, more FX, more crypto, and another wonderful business, because I think the European banks, frankly, weren't as efficient as the US. And the opportunity for Revolut, slightly different than Nubank, but was big. And that's my kind of take. And if you look at all three together, you kind of go, wow, big outcomes here.
I think when you look at all three together, that you do actually go, wow, Nubank is an incredible business. Chime, respectfully, just much different scale. 123 million customers for Nubank just really shows the scale difference. I would say that, as you said, the FX and the crypto being the core revenue driver for Revolut versus now moving more and more into secured and unsecured loans for Nubank being really, really hard. Such a defensible growth driver for them, which is so impressive. And
ironically, the pun is Nubank is old bank. It is both Revolut and Chime exist, and I don't mean this on the fringes, the opportunity, right? Whereas Nubank is like, no, if the CEO of Bank of America in 1908, Giannini, went to Brazil today, he'd be like, I know exactly what these guys are doing. They're banking the middle class, top to bottom, right? It's an incredible story. Interesting as you size up the Revolut opportunity. It's a very crude metric, simplistic, but the fact that Nubank has a larger market cap than our equivalent market cap to the largest market cap bank, I think is Unibanco in LATAM, just speaks to the opportunity when you can make it happen.
At 63 billion, do you not still think it's actually quite underpriced given where it could be?
On an earnings basis, I can see why you say that. In the end, but again, back to the only negative about being old bank is in the end, if you're not careful, you end up trading like old bank. And, traditional banks, once they become mediocre, mature businesses, they trade on a multiple of book. and Nubank would be very overvalued on that basis. So I do think there's upside there because they're only in 3 LATAM countries. There are other countries too. There's more room to run. So from a revenue and OI perspective, yes. You do wonder, when do the dynamics of just being a bank start to catch up with them? Do they get regulated? Do they start doing bad loans? Do they all? I mean, invariably banks at scale do dumb stuff. It's kind of their genetic disposition. And if they can avoid, maybe the better answer is this: if they can continue to do what they're doing and avoid doing dumb bank stuff, yeah, you could see a 2x from here, which would be wow. Which would be just a wow outcome.
I agree, and I think much more. And actually, I think when you look at Revolut's product expansion versus Nubank's product expansion, and how few products Nubank have compared to Revolut, and they could have very much the similar, and also in terms of revenue potential with each of them, wow, it could actually be a $300 to $400 billion company.
These are at the edge of consumer investing. It's not my strength. But the one thing I think about and why I'm especially impressed with the seed investors, right, is if Nubank has 35% market share of Gen Z in Brazil and Revolut's all across Europe, but if almost 20% of everyone in the UK has a Revolut account, right? You don't want to be number 2 or number 3. and you can compare it to Chime, but if Chime has less than 5% of US holders having an account, it's very different. So these are incredible outcomes. Predicting this at seed or pre-seed may be beyond my skill set. It's pretty impressive because you want to see this is massive market share in the largest part of the economy, right? This is like a double. On the 2x2, you want to be number 1 in the entire plumbing of a nation's financial ecosystem. That's an S-tier bet to make it seed, isn't it? You're not just rolling up to the latest plumber software and seeing 18% month over month growth in their AI fueled agent and saying, let's do this one. This one is knocking it out of the park from the pre-seed seed stage.
But I think the smart thing all of them did was, obviously have huge aspirations, but find a very profitable entry niche. And I think for Revolut, it was definitely, trans-country money movement. You find, the way I describe, you just find something that the banks just do so badly, and they're just robbing you blind as an individual. Like I'm not a Revenue user, I'm a TransferWise user when I'm sending money back to Ireland. It's just so much a better product than the banks. It's just, you type it in, the money goes, right? And Revolut what they've done really well is starting off with a niche product that is very, gross margin, CAC to LTV positive, and frankly gets a bit of consumer love, because you just hate getting ripped off when you're moving money, and then suddenly it's good. And then building, what Harry said is you just build, for year after year, for a decade plus, just add all the other shit over time, and you wake up one day and realize, oh my God, it's not my account for moving money overseas, it's my account for money. And then it's my account where I do my crypto, if you do it. And then suddenly you just, for that, as you say, for that next generation, it becomes their primary bank. It takes a generation, but it's unstoppable.
When I had Nick on the show from Revolut, he said, we think about banking like snacks. We want you to start with a little snack, which is, FX. Yeah. And more you use it, and you see that actually this snack's great, and I can add this really routinely. And then suddenly the snack becomes the meal, and then the meal becomes the whole meal. And now it's reported that 35% of users have it as their primary account, which is interesting compared to 50% of new banks, but still really impressive.
And what's also interesting about this is, in a world where banks were tied to physical infrastructure, you couldn't have a bank for a specific demographic type, because you had to have a bank for a specific geographic type. If you're the bank for Northern California, you're the bank for Northern California. You deal with old people, you deal with young people. On the internet, instead of slicing by geography, which is how banks have been, for time immemorial, and how US banks are regulated, you could slice based on demographics or based on propensity to buy a certain product. And it really just turned the table. And, you see it, and you also see it in Europe. Instead of being there was a bank for the UK, there was a bank for Germany, they catered to Harry, they catered to his mother, they catered to his grandmother, they catered to the local SMB. Revolut was just able to carve out, this is the niche, people who want to move money from A to B, regardless of what country you're in, within reason, obviously some regulatory issues. So it was, the big aha is the acceptance of internet, which has taken, frankly, 15 years longer than all the people who funded the neobanks in 99 and 2000. And I remember being there, it took, 20 years longer than people thought, maybe 10 years longer for people to get accepting of it. But once they did, you just, as you say, Jason, had this opportunity to disrupt significantly, one of the top 3 market cap sectors, FinTech, financial services on the planet. So these have been great compounders.
Final thing, and then we'll move on, but it astounded me this. Revolut internally has 26 new products that they are kind of baking in their venture lab. And they have insane testing, metric testing every week with Nick to determine what makes it to main stage. And they run them like little venture teams with different funding goals. It is where Nick is truly world class. I have all the founders that I've interviewed, and I've interviewed, Jason, me and you've both interviewed hundreds and thousands. He's the best I've ever met.
I'm pretty impressed. This playbook, I'm impressed with how many of the S tier founders can run it, where they get 20, 30, 40x founders together and have them be little GMs of their product line. I mean, we've all had, if as founders, everyone had 1 or 2 of these. Like, they'd find one founder and they trick them into coming and running something for them. But the Ripplings, even Owner, or I'm on the board, others, where you're seeing double-digit numbers of CEOs join to be GM. Sounds like at Revolut too. It's a disruptive way to build a company at scale. It's a superpower to be able to convince them to join. It's a superpower to get for CEOs to do this. It's not easy.
Yeah, absolutely. We've seen some of that in the portfolio too.
Yeah, like getting like 10 or 20 of these guys to join.
You said about the edges of consumer there. FinTech's been super hot for a while now. We're seeing it now with Revoluts and your Nubanks of the world and your Circles, and we can continue. Consumer's been shit. Everyone has been shitting on consumer, and especially consumer goods. And On seems to be the anomaly that just keeps on giving. They have 4 billion of sales, up 38% year on year. Software like margins, 61.5%. They're worth $15 billion. Is this a shining light in a beacon of darkness for consumer, or is there a pathway for consumer brands in venture?
I don't know how you get from On to brands in venture. I mean, look, it's clearly an amazing company. You look at the story, founded in 2010, public in 21. Just killing it in the high-end running shoe marketplace. I think it's a thing. I don't know. And look, but I don't know how applicable that is. I don't know, is the insight from that someone should raise a fund doing consumer goods, or in particular, are they going to, or is it just, not everything in life is noble, predictable, or lends itself well to venture type investing. I think some things are categories of one and they're very hard to access. And that's the kind of deal where you just go, good on them. I'm not sure you build a repeatable venture fund around that.
Speaking of categories of one then, CoreWeave is up to 11.2 billion. I know I'm switching, but I'm just interested. And I'm on schedule, Rory. So, to be fair, it's in the notes.
Before we go to CoreWeave, I actually a better thought there, because I lost much. I should think a little more about your comment on versus Jason's comment on FinTech. I think one of the things most venture needs is some kind of mega trend that's pushing these companies along, where you can say these things are happening at a wider scale, and therefore companies will be formed in this space, and you can have some a priori belief that they'll be big. And I think even though it was hard to predict, I think the Chime Revolut opportunity was knowable. You have digitization, you have the internet. You could see there was this kind of forming consensus that there would be stuff in FinTech. I remember looking at Simple, which is a predecessor of Chime. It didn't work out. Banco Santander bought it. But there was this thing could happen over the next 10 years. And venture can think about it, form a little theses, and someone will be there ready to intercept the Chime or the Revolut ball, because the trend makes sense. I think something like On, it's very hard to predict. There's not a whole set of trends. It's very much, category of one. You can say, hey, running is a trend, or high-end shoes are a trend, but it's just not as scalable. So I think I didn't explain it as well the first time. That's perhaps a better explanation of why consumer FinTech can be an investable venture trend, and high-end running shoes are going to probably be a one-off anomaly. Sorry. You can go back to CoreWeave now, but it's just so much more interesting than high-end. Yeah.
CoreWeave, 11.2 billion in debt. We're also seeing a load of other players. join them or join the model. Nabius being one, which is kind of a weird structure. Mistral is moving more and more close to them. First, how do we feel about the news that CoreWeave's up to $11.2 billion in debt? First.
The quick answer is duh. And I'll tell you what I mean by that. If you just look at I loved their very succinct, whatever's Q2, Q3 investor presentation. It's like, here we did $1 billion this quarter. We're going to do 4 or 5 billion for the year. Duly noted. Loss of 800-900 million. Not that much. And then you look next. CapEx planned for the year, 22 billion. Okay. They're spending, once you decide to spend 22 billion in CapEx, you're going to have 11 billion in debt. The way you think about CoreWeave is they're the guys that are doing the pointy end of the bet that Meta, OpenAI, Anthropic, all these guys are talking about. We want to deploy a shit ton of GPUs and a lot of data centers. CoreWeave are stepping up and saying, we will be the financing vehicle to make that happen. I love the Barron's headline. The Barron's headline said, I think it was Barron's, they said it all. CoreWeave's borrowed $5 billion in debt. It won't be the last time. Right? This model, and there's nothing wrong with it. It's a real estate company. They're in the business of a very, very sophisticated, clever, risk managing real estate company. They're in the business of borrowing large amounts of money, building data centers, signing long-term leases. If you're going to grow revenue from 5 billion to 10 billion, you probably have to grow CapEx from 10 billion to 20. So they're going to be doing more of this.
Does the debt matter? And what I mean by that is, just pause, when I interviewed the founder, he was like, we borrow when we have long-term demand. What's the issue?
I think obviously if he can match his debt structure with his demands from customers who will do take or pay, then it doesn't matter. Risk management is all a matter of degree. There's no hard or fast, and people are trying to do hard or fast. It's just not kind of doable. It's absurd. You can't do this business without debt, right? But, what will kill you, and I can't remember who did it on Latent Space, but someone did a really nice discussion on this. If you have long-term expenses and your customers are, short-term inference customers, then you've done the classic banking thing. You've borrowed long and lent short. You've lent long and borrowed short. You can be caught short, right? Your customers can evaporate in a month and you still have a 10-year lease. If these guys really are signing up Microsoft and OpenAI to a 7-year contract and they have a 7-year debt profile, then provided they match it, they can manage. Which of the two is going on? I don't know. I don't have visibility, right? But that's the bet you're taking, is that, I'm sure they disclose things like what percentage of your long-term fixed charges are met by take-or pays. Now, implicit in that is that the company at the other side of the take or play is willing to continue to take it or play it, right? If times got tough and people didn't want all that capacity, it's been my experience that people fight really hard to avoid paying it. So it's not riskless, but they strike me as having they seem to well understand the risk they're doing, whether they can in fact fully hedge at TBD. Sorry, Jason.
My only question, I'm just watching, I'm just learning. They need this debt. They're going to take another 10 billion this year. They already said, right? They got to buy the GPUs, and the hyperscalers are offloading some of this risk to CoreWeave, and they're guaranteeing it as part of it. There's a slightly cynical view of offloading your risk, but guaranteeing it, put it in air quotes. But I'm really just to learn. I just see it as the canary in the coal mine, right? OpenAI will find the capital it needs. Microsoft will certainly find the capital it needs, right? But CoreWeave, if CoreWeave struggles, if it can't service its debt, if it can't raise more debt through this weird through the hyperscalers guaranteeing it, that's where we'll see. Even if there's just a bump in this cycle that doesn't last, I think we'll see the bump in CoreWeave before we see it in the folks one level up market. You're not going to see it in Microsoft. OpenAI isn't public, right? You're not going to see it in Google. They're too big, but you could see that canary in the coal mine right in this public one due to exposure.
That's very true. Or even in the to Harry's point, even in the wannabe CoreWeaves, because CoreWeave at least has public liquidity. But yes, it's in a downturn. It's amazing how quickly liquidity evaporates for this kind of product.
Yeah. So if they have a really rough quarter, we may see something there that you wouldn't otherwise see, right, in their end customers. We might see it a quarter or two early and not show up, right?
I'm sorry, teach me, Rory. Why would you see the supply of cash go away in a down market for this type of product, given the quality of customers that are guaranteeing revenue being micro.
Agreed. If they have, well, what? If they have the customers, for the companies who have, if you have a 7-year contract, easy, Harry. If you have a 7-year contract with Microsoft that's a take or pay, and you have a 7-year debt, and it's perfectly amortized, and the contract's ironclad, you're right. There's no risk on that contract. Let's just say you're 3 years in, and Microsoft is not using its take or pay, but it's still paying its commitments because it's Microsoft. It's the only AAA credit out there, better than the government. It pays its bills. So you're fine on that asset. But I'll tell you one thing you won't be doing. You won't be building another one, right? And that's my point. So it's not like perfectly matched businesses will be fine. But if there's some up-and-comer who's maybe built another data center a little bit on the con because they thought they'd get some contracts because Microsoft is going to continue on expanding, and then suddenly that's not there, that's the guy who'd be struggling. Right. So to be very clear, if they're well matched, then despite the debt, they'll be fine. But the point is, it comes right back to the Databricks discussion. All this depends on 3 to 5 more years of continued AI CapEx expansion. If that's the case, everything works. And if that's not the case, all bets are off.
Yeah. Or even if, listen, obviously, I think a lot of this is disclosed in a way that's most favorable to the company, right? If they say all their customers are 4-year or longer contracts, 98% are take or pay, that sounds great to the public markets. One, going to Rory's point, there may be asterisks and daggers in those agreements, right? No matter what it says. They may not be as ironclad as they look. 2, even if they're not, if they pay rather than take, that's a canary in the coal mine, right? If the quarterly release is OpenAI has determined it's cheaper to pay rather than to take, that would just be an interesting canary to see that maybe there's a bump. Maybe there's a bump in the road. Even paying is a canary rather than taking.
And you always feel kind of a bit of a Luddite even raising this risk, or at least I do, because I know now the trend is so strongly expand compute. People are talking next year bigger than this year in terms of hyperscalers scaling. So I'm not like saying it's the most likely outcome, but it is simply true. You have to at least encompass it as a possible outcome. I mean, you have to have 2 scenarios. One, continued enormous growth, and then what would it look like if it didn't? And when that happens, you just don't want to be the marginal player, because not everyone will go to the wall, but the marginal player will. You want to be Goldman Sachs, not Lehman Brothers.
I was speaking to the CEO of one of these largest players. I can't name them, otherwise they will literally sue my ass. But he was like, Harry, you literally just don't understand. The only thing that is limiting me now is supply of compute. I'm so voracious, but you don't understand. I feel like a drug addict, chasing. Nothing is enough. And the scale of my demands are so much more than anyone knows.
Yes, that will be true today. And it will be true.
So if we then were to extrapolate that to a little game, Rory, because I know you love games, is CoreWeave over or under 60 billion market cap next year? It's at 43 today.
I don't have a meaningful answer to that question.
Well, you're a venture capitalist. We don't always have to.
But actually, one of the things I'm learning, especially on this podcast, is not to opine, is to not to try and fill the need to have an opinion just to fill the space. I would say the logical answer is there's probably a third or more chance it doesn't. Right? It's not 100%. I'm not determined. I'm not absolutely certain, but I can contemplate at least a 1 in 3 chance that sometime in the next 12, maybe 24 months, that demand slows down just enough that people penciling stuff out to the sky suddenly realize maybe it will taper down. And at that point, a lot of these multiples could compress. So I'm not going to say it's going to, because that's the question you asked, but I am going to say the probability of continued infinite AI demand, the probability of Sam Altman's trillions might be high, but it's not more than 2/3. There's at least a 1/3 chance that we end up in a period of time where demand slows, and at that point, some of these stocks probably wouldn't trade at those valuations. That's all.
Not that I'm an expert in public market investing, but I would just say, look, obviously CoreWeave is riding the right trend, right? It is it is inherently tied to Microsoft as its dominant customer, and OpenAI, who's guaranteed it $12 billion of revenue. So it's got to run. But this thing just went IPO, and it peaked June 20th at $183 a share. It's half that today. It's half that today in 2 months. So the variability here, the beta, the alpha, it's very confusing because, my knee-jerk response is, sure, bet on CoreWeave. The trends there. Sam Altman just said he's going to spend $1 trillion on infrastructure. He's got to send a few of those nickels to CoreWeave, but it's already down 50% since its peak, even though the macro trends are strong. And we're all investors in NASDAQ QQQ. Like, we're all up massively. If just in our 401ks or our private, we're all making so much money off AI, just being in NVIDIA, Microsoft, and the top 7. Why CoreWeave doesn't seem to be doing better if it's down 50% from its peak. So maybe we're fine just all living in our QQQ. I mean, that's the only, the weird thing about the stock market today is that's all the gains. The long tail is not doing well in the US. It's a weird world. It's not the long tail. And this whole economy is being inflated in a good way. We're all living in the bubble. It's not just the VCs. We're all living, anyone with exposure to VTI or QQQ is living in an AI bubble, whether they realize it or not. We're all benefiting from this one because of the hyperscalers, right? We all have Microsoft stock. We all have NVIDIA stock. We all have Google stock, and we even have Meta stock, even if we don't realize it. I think, isn't NVIDIA like 15% of QQQ or something like that?
NVIDIA and I think it's NVIDIA and Microsoft are 15.8%.
15. Yeah. So we're all deep in it.
And it's 36% for the top out of 5 or 7. I can't remember which. Yeah. No, it's astonishing. And what do you do with that? So the question is, what
do we need CoreWeave?
Well, no. What do you do with that information? The serious comment. What do you do with that information? What you basically said, Jason, is the stock market bet is entirely predicated on the AI bet, right? Which is astonishing. For example, the Sam Altman quote, so clever. We're going to spend trillions. Do you think that's someone who sat down and added up they've raised 50 billion so far, so they've probably spent some amount less than 50 billion. Do you think that trillion is a real number or a metaphor? Let's start with that. No company on the planet has spent $1 trillion in CapEx ever. Right? Do you think that's a budget estimate for the next 5 years, or do you think it's just some out of my ass conceptual number?
I think everything he says is very thoughtful. I think he needs $1 trillion. I think we're all going to live in AI 24/7, and we're all going to use 10 times the tokens and 10 times the compute we are now in 24 months. Like, help me do the math. If we're using AI 20 times more a day and 10 times more tokens, if all things were equal, which they're not, how much more do we need to spend on infrastructure to spend 200 times what we're doing today? What's 200 times today? I know there's not enough capital in the world, but it doesn't. But
don't gloss over that minor problem. The odd thing now is we're at the stage where the size of this single trend is now capable, as you correctly point out, of influencing macro trends like global aggregate trends. As you say, it's 37% of the stock market. It's a significant percentage of total domestic CapEx investment. I went and checked. Turns out, we spend about $1 trillion. Corporations invest total $2 trillion, of which roughly $1 trillion is on buildings and shit, and roughly $1 trillion is on capital equipment, right? So basically, we're talking about taking, a third to a half of everything we invest in everything in the US. I don't know I think we may have reached the point where, as I say, I think these are numbers as metaphor rather than numbers as real doable numbers. I think the aha here is we're going to spend a lot more than we ever did. It's hard for me to imagine it's $1 trillion, and it's also even harder for me to imagine if it is $1 trillion that it pencils out. Now, Sam Altman is so smart, and he even worked into the same comment, and he said all the economists will be wringing their hands, and maybe I'm just doing that and wringing my hands. He's very good at anticipating the counter comments and preempting them. He's such a talented guy for that. He did that. He did the people are going to lose money. So it's like because when people say it's not a bubble, it attracts antagonism and people want to argue with them. It's very disarming to say, we're going to spend $1 trillion. Pause. Economists won't like it. It might be a bubble. Oh, but by the way, we're fine. It's like, I see all the negatives, but just give me the truth. It's so freaking clever.
good.
Wonder he's a fundraising genius. But the question is, can you take this trend to the bank? Because literally every discussion we've had, starting with Databricks, all the way through to CoreWeave, is how long can you take the trend to the bank? And I don't want to be the cynic, because, I do believe the common inventor that cynics sound smart and optimists die rich. So on aggregate, you should be an optimist, but you just got to keep your eye open on the downside.
But hold on, help me with, Rory, you're so good. I don't mean to interrupt, Harry, but if Amazon, Alphabet, Microsoft, and Meta are going to spend $365 billion in infra today, $365 billion today, if OpenAI goes on its trajectory, and we talked about consumer, it's the most successful consumer app ever, right? Software app ever. If they're doing 365 this year, can't OpenAI consume $1 trillion in CapEx?
No.
I mean, it can't raise it. I mean, other folks have to do the investment, but can't it be the engine of $1 trillion if they're 365 today? And this 10x's? It 10x's the compute we need?
No, because the 365 that's being invested by the 4 most profitable companies on the planet is already straining their balance sheets. Facebook is stunningly having to start borrowing money, right? Microsoft CapEx as a percentage of revenue has crept up to 25%. It's all knowable, right?
Yeah, it's huge.
Yeah, we're reaching the limits of what people will want to finance. I mean, maybe over a decade or 2 decades, you get to $1 trillion. I mean, even over a decade investing $1 trillion is $100 billion a year. $100 billion a year in a world where the most profitable company on the planet, well, that's not true. Google's more profitable than Microsoft, but all of them are spending 50 to 80. That implies a non-profit making company can invest more aggressively than a $4 trillion market cap company that kicks off cash. I don't buy it. So again, I'm not arguing the direction. My point is, I think it was trillion as metaphor for lots, not trillion as FY26 CapEx plan by quarter.
Yeah. But if we're sorry, I just want to get your thoughts, Harry. I don't mean to monopolize the conversation, but if in 20, the math makes sense, right? Maybe it takes a decade to get to the trillion, and Sam did say we need some new financial instrument to finance it, which is telling, right? But if we're going to use AI 10 times more often in a year or two in our lives, and we're going to use 10 times more compute, that's still a lot of infrastructure we need, isn't it, for 100x more AI?
The good news, Jason, there's some CoreWeave's calls that you can buy tomorrow morning.
Right now.
Right now will give you the joy of that bet in financial terms, baby. Knock yourself out. Sorry.
To me, it all goes back to this very wise statement that you said, Rory, which is the only thing that matters in this next wave is that we are going to see the transition from technology budgets to human labor budgets. And if you see that transition, you've got $10 trillion of value unlocked, and then spending trillions over a long period of time becomes a lot more feasible or rational. And if not, then absolutely not.
It's just early. That one is so interesting. And I'm only so smart. I was skeptical a few months ago of that. I was skeptical. I'm not seeing in B2B software. I'm not seeing, we're going to have Mark Benioff, which will be great, right? But I don't think he's going to tell us half of Salesforce's growth is going to become replacing humans with Agentforce today, right? So if we look at our portfolio companies, I know we can make up some stories. We're not seeing trillions of human replacements with AI robots today. Not yet. But man, I can see it much more than I could 90 days ago. I can see it so much. I mean, we have 10 AI agents at our little team that have replaced 5 humans, and it's going to go up. And we only had 1 person at our stand-up yesterday because it was all AIs and us. And it's just, it's early, but this wave may accelerate I think 6 months ago is VCs talking their hand, right? In 6 months, this could be what all CIOs want. All CIOs could be like, you got to be AI first, not just the Tobys and the others. They all could be like, I'm not giving you $1 of budget until you find me an AI solution first. Then we'll talk about humans. This could become mainstream.
I think it's a pace question, because I will admit, I'm one of the reasons I like doing this is I come on and I change my mind. And Jason, your comments, I thought last week on Shopify were the bomb. The numbers, and then your comments on your own organization and how you've been able to automate have really made me pause my thinking, right? And I've become convinced that at the pointy edge, the really smart you're definitely seeing this labor replacement, right? And I agree with Harry then, if you can contemplate that at scale, then you can talk about trillions of dollars. I think it's a pacing issue. So now, and what I try and take away from here is, what am I paying attention to right now to figure out, my investment strategy? And it really is on all my companies that are selling AI products, B2B products, how well are they doing with forward-leaning customers and overall in terms of driving adoption and then driving efficiencies? And they're doing well, and you can see it. It doesn't happen quickly though. It's still, it's like, I think, and you have the high propensity to buy customers like you, Jason, and then you have the big dollar customers with a much longer time horizon to ramp, in corporate America. So I think the trend is real, but the pace is, to me, the big question at this stage. And it turns out if you're spending $400 billion a year, pace really matters, because the time value of money is going to eat your ass at $4 billion.
I'll tell you an interesting just for venture that I realize it. I'm a little slow here. Now that we have 10 real AI agents productions replacing humans, the pace is slow, but also consolidation may happen before the pace accelerates. And what I mean is, we added up the nominal list price of our 10 tools, right? $500,000. $500,000 and going up, right? So you could imagine that could be $1 million by the end of the year. You know what folks are going to say? Maybe let's just use the ones we have. Because there's a weird, we did the math, $500,000 already that we're using. And every B2B startup out there raised, with these gigantic growth rates, not the prosumer stuff like Lovable and Replit, but a lot of the ones we look at, they're all trying to charge $60 to $100K a year. That's like the list price. It's like $60K a year to start plus $40K for onboarding. So that's $100K. And then we want to upsell you in year 2, right? So it's so exciting, and there's so much budget out there, because this is the only thing CEOs are putting budget for, right? Is these AI projects. But we may see a wave of consolidation like we saw in 2022 in AI, even next year or the year after, because it's just too many AIs that are 6 figures and up. It's too many, right? And for us, $500K, $1 million bucks. I mean, Harry, if your team was spending $1 million a year at 20 VC on AI agents, would you be cool with $1 million, or would you want to have a meeting? And you might say, like, this gongification consolidation, you might want to do it. We may see a lot of these folks who are excited about our portfolio get consolidated out sooner than happened in the SaaS wave, sooner than it happened.
I think that's actually, again, I try and come out of here with insight. I think that's a real insight, Jason, because I'm wrestling with that. You're seeing exactly. It's everyone thinks their thing is going to save labor, but you can't all get credit for the same labor. So you might see, like, I think stories like the Rippling story happening much quicker, which is, we're going to give you 5 agents and an orchestration layer. We'll make it all happen, because if we just do one, it's just not enough. I think that's actually an interesting point, which, may mean a much quicker consolidation story across these plays.
Like in sales, do I need an AI tool, an SDR tool, a BDR tool, an AI CS tool? These are all 5 folks trying to get 500,000-600,000 of you. I think, and we're actually already seeing this, going to our conversation, we're already seeing this consolidation in e-commerce, if we want to chat about where they're becoming one tool already. I think it's a real risk for all these cool ones. Like, we just don't need 5 of them. Going to Rory's point, Rippling's a good example. We may want everything from one vendor in 12 months. And maybe the most AI startups can't keep up. It seems so easy in the beginning, but I don't know if they can keep up with that Rippling pace.
Yeah. And by the way, that also goes back to the myth of the one-person billion-dollar company. I think economics works really well at competing away excess profits. This trend basically says, you think you might be able to get away with that, but this other company is going to have 5 of these agents and compete against you. And I think it speaks to, nobody allows billions of dollars of enterprise value to go unclaimed and uncontested. And as I'm thinking now, and genuinely what many of my AI forward B2B companies are wrestling with, this resonates, having enough surface area of value. Because one of the things we learned actually in robotics, which was very clear there, and maybe it applies here too, is that it's not enough to say, you'd see it a lot in robotics, which is, here's this product that can automate this particular problem and can reduce the labor by half, 2/3. It's wildly efficient. It pencils out in terms of ROI, right? But in a warehouse with 300 people, you're only automating 2 workstations. It doesn't matter. One of the reasons we have done very well with Locus, one of our companies, is picking is actually the number one thing people do in warehouses. So your automation attacks a much larger percentage of the labor. And my learnings have been, it's not enough to be ROI efficient. There's only so many things you can get your head around as the CFO or the chief of operations in a year. So you have to have a quantum, you have to be able to not just have a high ROI, but have a high ROI on a fairly large quantum of headcount. Does that make sense? Because it's just the brain death of doing it.
Yeah, I think everyone for the last couple of years has been cutting the number of SaaS apps in their organizations. No matter how well they're doing, they get around the table each year. We've got to consolidate. The last 18 months, it's gone the other way. They're saying we got to consolidate our SaaS apps, but do the AI stuff, guys. Go pick a few of those. Here's our budget. I think it's either next year or the year after they start to consolidate them. It has to happen faster in this trend. It just has to happen faster.
You're exactly right. It's not going to be in 10 years.
Yeah, now I've got 200 of these AI apps my team bought, 100 SaaS apps and 200 AI agents. It's too much, guys. Pick your favorite 50 and we're done. And you got to cut 150. It wouldn't shock me because there's so many paid agents running around now, more than SaaS. It's soon going to be much more than classic B2B apps. Everyone wants an agent for their department, don't they? Or 5. They want 5 or 6 agents.
Does this increasing trend towards consolidation of budgets and assets that you want to engage with, does that harm vertical SaaS in a way that we should think about investing in vertical SaaS today?
I don't think so. Because to me, because by the way, some people often use the word vertical to mean functional. Like sales is not a vertical, it's a functional. Vertical means like for insurance or for healthcare. In those areas, what I think the trend is that once you become the dominant solution, it's actually easy for you to vertically integrate. Like, give you an example, Viva in healthcare, in the prior SaaS generation, they started off with a single point product, but once you earn the trust of a vertical, where typically there might only be a couple of hundred key customers, if you're selling them A, and you have a really good product team, it's much easier to sell them B, C, and D as well, all tailored to their specific market. So I think what you'll see in these verticals is I think you'll see it's good for the dominant player and they'll just be tucking in and adding in other shit, for lack of a better term. Is that if you're the king of revenue cycle management in healthcare, you're just going to add a whole bunch of other insurance claims processing related stuff. Ditto across all, if you're doing, and we're seeing a lot actually, it's interesting. Voice bots, for example, obviously voice is now doable. Voice is a wedge in hundreds of different verticals where you can go, because the ROI is really compelling. You used to have all these phone calls. Some of them don't get answered. Now you add a person. Now you add a voice AI and it deals with all that. It's really compelling. They're seeing fast growth. But in every case, we believe 2 years from now, this is just a wedge point and you better add way more functionality such that 2 years from now, you're not just handling the call, you're handling the booking, you're handling the refund, you're doing whatever it is the customer wants on that call. So I think it gets back to the same thing. You find these cute little wedges, but then you got to scurry really fast to add breadth to the product in a world where your competitors are doing the same thing.
If you're in a bridge, are you shitting yourself when you see Epic announcing their transcription plans to go against your core product?
If you went into a bridge thinking Epic wasn't going to do this, you are a baby and your money will be parted from you sooner than you can say, gone, baby, gone, right? A bridge is the most impressive profit extraction machine in the healthcare industry. So they partner with Epic. So Epic, which just to remind everyone is, extraordinarily privately held company, founded in 1979 by Judy Faulkner, is just astonishingly successful, has like 40% plus market share in the healthcare records marketplace in large US hospitals. It's dominant. I think it does 5 or 6 billion. It's a magnificent business, private, wildly profitable, incredibly tough to deal with and partner. They partner with, I think it was a bridge to have this new scribe product that a bridge has. But I'm sure a bridge went into this eyes wide open going at some point, Epic's going to announce their own product and you better have the best product, right? Are you nervous? You're darn right you are. But there's only one thing worse than partnering with Epic and getting smacked around by them. And that's not partnering with Epic and not even get a chance to get smacked around. Because if you're not with Epic, you don't have access to 40% market share. So, again, turns out that no one rolls over and dies and gives you $5 billion of market cap.
The whole issue in general, we'll run a maybe for, these platform risks like you talked about. And there's many of them. These are ones we used to shy away from in venture. These are one of the many risks we're ignoring today because the growth is epic. We're ignoring so many risks, and platform attaches all over AI B2B. There's so much platform risk, and we've given up worrying about it.
That's actually a great point, Jason. You're exactly right. Because you should be sweating that. I mean, I love that. Platform risk is everywhere. And this is just one example of it. I mean, I think, it's the whole cursor anthropic discussion we had before. But
we're going to listen, gross margins. The top line is so attractive. We're going to ignore the top 10 traditional venture risks today. That's what everyone's doing. And I'm not saying it's bad. It's just so different to ignore. These would be classic. You debate this for weeks in 2019. We'd be at the partner meeting at Scale. Rory, I'm real concerned about a bridge. And if Epic it locks their API access down, let's pass on this one, Rory. I just don't see, I've never done well on these platform adjusted risks, but I've heard good things about Klaviyo. But Klaviyo and Viva and Salesforce, we got to pass on this one, Rory. And that conversation doesn't even happen on Mondays now, does it?
It's stunning to me how good that was, Jason, and how true that was. And you're exactly right. I remember those sentences, and you're right, we're not having those sentences as much today. And it speaks to something I think we said shows ago. We're way out there on the risk curve, every one of us right now, right? And the only thing between us and Armageddon is AI adoption. If AI adoption keeps happening, this whole wagon train keeps on rolling and we're all going to be fine and we're going to get through to California. If AI adoption slows down, then it's going to get ugly real fast across the board. You're exactly right. And, because Abridge's bet is, Epic has a product, but our product is so good that the doctors will want it, and they do, and they'll want it, and they'll love it, and therefore they'll be able to parlay past the platform risk, right? And intrinsic to that is this belief that the magic is so good that, you'll be able to, and it's not a crazy bet, that you'll be able to overcome the inertial resistance of bundling. And, because I think doctors do have a say in this, because, we have a play in the kind of smaller medical space and a similar thing. I think doctors give a shit about this because it impacts their time. And the entirely rational Abridge bet is if you have a good enough product, maybe medical will say, we'll stick with this. We won't go with the bundle product because our poor doctors are spending hours taking scribe notes. But it's all dependent on the magic and the end user adoption being a strong enough lever to just, as you pointed out earlier, pull the entire US economy up the hill.
Boys, speaking of platform risk, and we mentioned Anthropic, OpenAI, we're going to do a Kalshi quickfire round. As we know, Kalshi bases these bets and there's kind of predictions on them with weighted variables. Will Anthropic release Claude 5 this year? Rory, I'm giving you odds, 100. If you bet yes, gets you $322 back. And if no, 100, you get 17 back. I would say yes. Given those odds and given the need for speed and given GPT-5, I'd say weighted, that's a pretty good bet.
By the way, it's interesting because it's always hard to do on this kind of soundbitey podcast, because what you're really saying is in a 50-50 shot, probably not because of the pace of their prior things, but the odds are so good. Right. And the other problem is then people go, well, you said it would happen and it didn't. And it's hard to remember. I agree. Probability adjusted, you do it, even though it probably won't happen, but the odds push you that way.
There's no chance, I think.
Yeah.
Because, and listen, I say this only because I'm a Claude power user. I mean, I love ChatGPT, but I'm in Claude at least 90 minutes a day, maybe 2 hours. Right. And I'm vibe coding the other 2 hours. So I'm either in Claude or I'm in Sonnet or Friends, right? And my point just is there's two different worlds. Anthropic's revenue is so driven by programming, coding, all that piece, right? And they don't need and listen, Claude, the consumer app, does feel a little dated compared to ChatGPT. It memory barely works. Imaging doesn't, there's parts of it that are dated, but I think the market share is so low. They don't need this big consumer press release like Sam Altman. What they need is Sonnet 4.5 to crush the limited advancements that ChatGPT that OpenAI has made, right? And so that's what they need, is to win in their core market. And I don't think they need a consumer spike in the ground to do that. They need the next version of Sonnet to be awesome, right? That's all they need. They've already won that market. Now they need to keep up, right? Now they need to keep up.
Jason's vision is ChatGPT calls itself 5.0, but doesn't be awesome. Claude Sonnet calls itself 4. Whatever is next, 4.6, and is awesome. Got it. You
I
may
think
well be
so.
correct. It's not a crazy answer. Okay.
It doesn't seem like they really care about the consumer app, even though I love it. Like they care, but it's not. It doesn't seem like a lot of. I follow them. They just added a Twitter account for Claude, the consumer one, in the last 30 days. And it said we don't respond to this account on Twitter. So that suggests to me it's not a priority at the moment if it's brand new and they're not going to respond.
Mistral. Will any company acquire Mistral this year? Yes, $100 gets you $420. No, $100 gets you $113. So again, pretty shitty odds on no.
I think if you're not even at 100 million in ARR, you got to make a play right now, right? You either got to sell or you got to do the inverse one, like with Windsurf and buy. You got to do something to get scale. So if you're at less than 100 million in revenue and someone wants to buy your team for 20 billion today, I say take it. I say like spend the weekend thinking about 20 billion for your 100 million in revenue, but I would still take it even if you leave the VCs and the sales team behind. I would still do it. There's moments in time, right? And these moments are not going to last. These crazy deals, they're not going to last. And you got to take them if you're not crushing it.
It's very telling that Jason's question is whether they would take it, and my question is whether they would get it. Because I agree with you. If you get it, you should take it. That to me, which actually is an interesting guy. If you're not. It's hard to imagine getting critical mass. I mean, you could be wrong. Cohere just raised a bunch of money, but it's hard to imagine getting critical mass as a 4th or 5th player. But can they get it? I don't know. I don't have data.
If they got it, they would take it.
Yes.
I think the question is, will they get it? To your point.
I would agree with that.
100%.
Well, there's just going to be some weird deals, right? Scale's bought for whatever we call it, 15 or 30 billion, depending on how you look at it, right? With $1 billion something in revenue that's instantly abandoned, right? But yet is the anchoring points for price in the last round. There'll be other folks that are sub 9 figures in revenue, if that's what Mistral is, that get a similar like multiple or something. You got to take that arbitrage. Like none of these things quite make sense. You're abandoning the revenue. Does the revenue count? Is it proof of concept revenue? Like what does revenue even mean for some of these deals? It's confusing what the revenue even means if you're leaving it behind with the sales team. Like what is it just to justify the deal? Because sometimes M&A is about justifying a price. I mean, Rory, we've all been through a lot of deals. So many times the deal is a justification. 2x the last round, 3x the last round, 10x revenue, 50x, but it's just a justification, isn't it?
Final one, Jason, this is for you, but like be nice. I've told you we have to be nice on this one.
I'm nice.
Will Deal or Rippling IPO first? Final one, $100 gets you only 121 if it's Rippling. $100 gets you 174 if it's Deal.
Well, I'll just tell you, Rory probably has better thoughts. I'd want to know your thoughts, Harry, because you know the folks overall even better than I do. On the one hand, Deal says it's profitable. That certainly helps to go public, right? I mean, Rippling is in investment mode. So it's hard for me to believe. I mean, Parker's an incredible CEO, but it's hard for me to believe they would IPO in anything less than 24 months. Because they're doubling down on investing, right? The top line over the bottom line. If Deal's profitable, you have more flexibility. The quality of that, I'm not, no knock on Deal. I've always been a little, I don't have the financials. I don't know how much is software revenue versus PO revenue versus others. I've heard different things, right? So the quality of the revenue might be lower, but I'm putting this in air quotes. But at the end of the day, the bottom line is the bottom line, right? So Deal's quality of revenue probably isn't going to change that much, unlike, say, a Palantir that just before it went public had like 20% margins and then went to 70. Assuming Deal's consistent, might as well IPO now while they're profitable. But Rippling needs another 2 years, is my guess, in the oven to get to that. We're getting to break even this quarter. I don't think Parker's going to be there for 24 months. That's just a guess, and it's not a criticism. It's just investment mode.
I think Jason's assessment of the two companies is correct. One of them has a more transaction-oriented business that is more profitable more quickly. The decision to go there, public there or not, is a function of, internal readiness. Let's be honest, any pending litigation angst. But, if you could get liquidity on that one, you probably should. I think in Rippling's case, you're right. They're in heavy investment mode. It's a very ambitious task. There is an argument that says that's precisely why they maybe should go public if they are worried about, if they continue to need lots of capital. if there's, again, I'm always a worrywart. If you worry that the private markets get weird, having public capital wouldn't be a bad thing. But you're right. It would be less a fully baked story and more an ambitious continuing to grow story. So if you believe that the markets stay as they are for the next 2 years, broadly receptive, then the logical thing is what Jason said, deal to go now and Rippling to go when ready. Right? If it was to change, it would be because Rippling decides preemptively, I'd just like to take one risk out of my life and just have $1 billion in cash and a tradable stock. And again, as I say, I'm always you'll see a continued bias here, a bit of a scaredy cat. And I always de-risk. When the capital markets are this frothy, there's a little part of me that always wants to de-risk anything.
Chaps, brought to you from Greece. This was a pleasure. My mother is beckoning me. Otherwise, I'm going to get
Have some
killed.
baklava on us. I'll Venmo it to you.